This is one of the best investment articles you'll read this is insane. It's fantastic. I cannot wait to share this with you. Look, I read a lot of investment stuff, lots of it. A lot of it is tripe. A lot of it's just silliness, but every now and again there comes a piece that has got to be shared, and this is one of them for sure. So let's dive right into this, shall we? This is from a guy, Ben Carlson, from a Wealth of Common Sense. Yeah, wealthofcommonsense.com. He's affiliated with Ritholtz Wealth Management. Generally not the biggest fan of Ritholtz Wealth Management. Just rubbed me wrong. I don't want to get into it, but just generally not the biggest fan of it. But with that said, that doesn't mean everything they do is bad. Just generally speaking. So let's go to the Dateline, February 3rd, 2019. Simple versus Complex, 2018 edition. Jason Zweig recently chatted. Now, Jason Zweig is a Wall Street Journal columnist on the financial part. I think he took over for Jonathan Clements. These guys are similar in terms of somewhat arrogant, really demeaning for the financial advisory class as a whole. And look, and I'm telling you, man, I get that financial advisors, generally speaking, charge too much. I get all that, but at the end of the day, I find it that they do serve a purpose that a lot of people need, for sure. And just the way that some of these guys write in the Wall Street Journal, particularly, it's just demeaning. It really is. And then seeing Jonathan Clements go on to be on the board of directors for a firm that charges the 1% fee he was so adamant against, it just boggles the mind. But anyway, either way, he writes good stuff. I'm a fan of his writing, if I'm not necessarily a fan of his just negative outlook on the financial advisory business as a whole. That might seem weird because I rain on financial advisors a lot. I do because I don't think 1% is worth it. I don't think you should pay anybody 1% to run your money. If you got a couple $100,000, no, you can't. If you got $20,000 and it's costing $200, all right, that's one thing. But if you got a couple $100,000 and this is retirement money, you shouldn't be paying somebody 1%. If it's $20,000 and you're accumulating, I got no problem with that. I mean, I don't think. I don't have any problem with it. But as it comes to retirement planning, if I'm taking 1% a year off your portfolio to manage your money, that inherently reduces your ability to have a safe withdrawal rate by that 1%. There's just no two ways around that. So I'm not a fan of that at all. But I do think there's a lot of financial planning that can be done that you just might not be aware of. And you got to pay for that somehow. I mean, someone's got to get paid or else they won't do that for you. And I just think the idea of going to Vanguard and getting it for free, it's just not, it's not true. Anyway, all right, so Jason says, the money manager, he was talking to, he recently chatted with the ever-candid Charlie Munger, who's with Berkshire Hathaway, of course, Warren Buffett's right-hand guy, who had this to say about value investors. So this is Charlie Munger. Money managers among them are like a bunch of cod fishermen. After all, the cod's been overfished. They don't catch a lot of cod, but they keep on fishing in the same waters. That's what happened to all these value investors. Maybe they should move on to where the fish are. I 100% agree with that. It kind of goes back to 3, now 5 factors, a 4-factor thing. The factor investing Kudos is always a small cap value. Small cap value. There's 3-factor or 2. A small cap value, and I forgot the 3rd factor. I don't remember. But anyway, small cap value, small cap value, small cap value. Well, everyone then turns their turrets, shall we speak, to small cap value. And that loses its ability to outperform because everyone's going there. It's like the dogs of the Dow. I've said this a million times. The dogs of the Dow was great until it wasn't. Same kind of thing with small cap value, same kind of thing. Everyone says value, value, value. It's growth, growth, growth. It just always ebbs and flows. And you can always find an area that's been unexploited or maybe underexploited. But you think if you're the only one who has that edge, you're crazy. And so the idea is that you're not going to have that edge relative to everybody else. And if you are able to get it, it won't be for long. And then everyone else will exploit it too. And then there's no more edge. All right, so Ben writes, the same analogy may be applied to institutional money managers who overfish the illiquid alternative investment universe by following David Swenson's lead. This is freaking spot on. 10 years ago, something like that, David Swenson was cast. I probably still is. I have no problem with the guy. But everyone was saying the Swenson model, Yale, the endowment funds. Let's be like an endowment fund. And it was like timber, precious metal mining company, not the companies, but it was the actual commodity, the oil in the ground, maybe even wildcatters and all. It was timber. I just remember timber. probably real estate investments up in, I don't know, Vancouver, Washington, or something like that. And everybody and their mom wanted to follow that model because David Swensen was at Yale. He's managing billions of money. He is the best ever. One of the best and worst parts about this space in my experience is how much sharing of investment ideas and et cetera there is amongst peers. An unintended consequence of the sharing is an infatuation with peer performance. The peer benchmark of the majority of the foundations and endowments crowd focuses every year on the NACUBO-TIAA study of endowments. We know what TIA is, but I'm not sure what NACUBO is, but they do a study of endowment performance. The latest study of more than 800 college and universities, that's going to be college and university something, a National Association of College and University Body Odor, I don't know what BO stands for. The latest study of more than 800 college and university endowment funds, which manage more than $600 billion, was released. Even the foundations and endowments that are not affiliated with educational institutions use these numbers as a peer benchmark because the college endowments have always been seen as the best of the breed of institutional money management. I'd even add something to that. They've always been seen as the best money managers out there. The college endowments, Harvard, Yale, all the way down to the smallest school in what was that school in Virginia that was getting ready to go kaput, and then they I forgot what it was called. It was not Bridgewater College. Sweetbriar, I think it was Sweetbriar University, but it was college. Even the tiniest endowments, they always are seen as the best among the best, for sure. And for a long time they were. But there's an old saying that nothing breeds failure like success on Wall Street. I never heard that saying, but I love it. Nothing breeds failure like success on Wall Street. Here are the latest returns from NACUBO segmented by assets compared against a simple 3 total index fund portfolio for Vanguard. Oh, man, I love this so much. And I'm not even sure if this is net of fees, to be honest with you. It doesn't say. He uses Portfolio Visualizer, my man Ben here. So I get a lot of emails about Portfolio Visualizer. I've done some videos on that over a year ago. Maybe I'll do another one here soon. Anyway, for 10 years, over $1 billion in assets, you average 6% a year. Under 25 million in assets, you average 5.8% a year. A 60-40 Vanguard of, it's going to be 30-30-40. It's 30% total stock index, 30% total international stock index, and 40% total bond index did better. And again, I don't even know if this is net of fees. A 70-30 Vanguard did 6.6 and did better by far. And then a 90-10 Vanguard did 7.1. Again, just crushed the competition. Over 5 years, it's pretty doggone close. A 70-30 was within spitting distance of the $1 billion endowment, and it beat the under 20. It beat everything else pretty handily. And we were talking 50 basis points, 100 basis points here. So it beat everything handily for everything else. A 90-10 Vanguard smoked him. Now, Bob, that's too much in stocks. These hedge funds or endowments, they have more liquidity or more downside risk. And we're talking about that. Many investors like to use a 60-40 portfolio as a benchmark, but I showed other variations of the Vanguard index portfolio because their asset allocations for these endowments are all over the map. And here we see an example. This the over $1 billion only had 13% in domestic equities. That's it. 7% fixed income. All right, so we cannot sit there and say that this is, 7% fixed income, 58% in internet and the alternative. Again, that's timber. I don't even know what else they got. I mean, who knows? I frankly could care less. They got more in international than they have in the U.S. by almost a factor of, 40%. 10% between fixed income and cash. And I'm sure that's for their fees right here. Again, I don't know if these are net of fees or not. But anyway, that's essentially a 90-10 portfolio. 90% of equities of some regard and 10% was fixed income and stock, fixed income and cash. So a 90-10 portfolio over 5, 10, and 3 years got smoked. Or a 90-10 portfolio Vanguard smoked these. I mean, literally smoked these. Beat them bad. Without question. Again, I'm not even saying this is net of fees of these guys. And then you got the smaller ones, 45% U.S. equities, 24% fixed income, less exposure to alternative strategies. And I bet these are fund to funds because they don't have the cash to get into timber ownership outright, and 15% foreign stock. So, and this is the most, the most conservative portfolio of the endowments are 45% U.S. stocks, 60% stocks, 11% international, and or alternative, and was that 30% fixed income and bonds. So the most aggressive, most conservative of the endowments is more aggressive than the 60-40 portfolio that we're using here. But Josh, commodities, they give you downside protection. Let's take a look. So he would argue, my man Ben, as I do too, 60-40 is far too conservative when you consider that none of these groups show an average close to 60% in bonds. In fact, the highest average to bonds is just under 29%, like we just talked about. The funds that have over $1 billion average just 10% in cash. You could argue a 90-10 stock bond portfolio is far more appropriate. But these investors would tell you that their hedge funds don't have the same risk profile as stocks, so it's unfair to compare the two. But my contention is those funds with nearly 60% in alternative are taking on even more risk than stock investors. I could not agree with this more. This right here is critical. Alternatives are illiquid. Investors rarely know what the underlying holdings are. Private equity and venture capital are illiquid levered positions or levered equity positions. Hedge funds also utilize leverage. In my mind, that makes these positions far riskier than a diversified low-cost stock market index fund. Even if the volatility looks lower in these funds from the reported numbers, it is masked by the inherent illiquidity. This is why I said I could not agree with that more. So the best and brightest money managers that money could buy, if we look at them over 10 years to a 90-10 Vanguard, 3 index funds, that's it. The 90-10 smokes them. And we are talking, again, I don't even know if this is net of fees. We are talking 1.1 divided by 6. That's an 18.3% higher return every single year for the last 10 years for the 90-10 relative to the $1 billion endowment. The endowments have over $1 billion. For 5 years, it's even worse. For 5 years, 9.7 minus 8.2 equals 0.5 divided by 8.2. I guess that's the same thing, 18.3%, so exact same thing. Let's see, here, it's for 3 years, it's crazy. Minus 6.8, 2.4 divided by 6.8. That's a 35% 3 year, each year, not just over total, 3 years, each year. It averaged 9.2%, the 90-10 ones. The over $1 billion averaged 6.8, which is by far and away the best of all the endowments, by far and away. That's 35% less each year than the Vanguard fund. It's crazy. Some thoughts on these numbers. It's hard to believe how close the return numbers are between the large and small funds. Yeah, look at this. So here's the large ones, 6.0, 5.8. So 6.8, 6.2. That's pretty interesting. Larger funds have more resources, better access to top fund managers, more money to invest in technology, bigger travel budgets. But the competition in this space has all but leveled the playing field so much that the best performing group over the past 10 years was the 25 to 50 million endowments, not the one managing 1 billion. How does he say that over the past 10 years? Because it doesn't look like that to me. 5.8. Oh, okay, 25 right here. 6.1 to 6. Okay, so spin distance. The fact that the long-term numbers for these funds are so similar is striking when you consider how different their asset allocations are. Yeah, let's take a look. Here's a $1 billion one. Here's a 25 to 50 million. So the 25 to 50 million has 300 times, 300% more in U.S. stocks than did the over 1 billion. They had 3 times more in fixed income too. And that's coming because they don't have as much an alternative. That's interesting. I find that to be incredibly interesting. The biggest endowments have dozens of staff members who specialize in specific asset classes. Some of these people are paid millions of dollars a year. They travel all around the globe, meeting with money managers and performing due diligence. They have enormous committees and boards filled with highly connected and educated people, and yet the little college endowments with far fewer people and far simpler investment strategies using much smaller budgets and making much less money did just as well. The sheer size of the alternative allocations for the endowments with 251 million and above is mind-boggling when you consider the amount of time, energy, know-how, and resources required to perform due diligence. These funds basically doubled down on illiquid investments following the financial crisis, even though many of them got burned when they needed the liquidity the most. Yeah. I don't think there's a plan B for these endowments. They all spent so much time and effort convincing their boards that this was the right plan of attack, they can't turn back now. My guesstimate is that 60 to 70% of these funds really have no clue how their private investments are performing because these funds are so difficult to track. They won't know how this experiment will turn out for many years. And I think the majority of them will be sorry. 100% agree. The illiquidity premium was assumed to be a foregone conclusion by any institutional investors. It's time to reassess this idea. Man, I could not. That's just basically, look, you're going into alternatives. They are not liquid assets. They are not. So you're saying, we minimize downside risk. Well, you only minimize the downside risk so long as you can sell the funds and generate cash. If you can't do that, illiquidity in of itself does not generate positive cash flow. It doesn't generate what's called alpha outperformance. That's crazy. Maybe the past decade is an aberration. Maybe the bull market has skewed these numbers and the biggest fund will once again prevail over the next decade. Anything is possible, but I think it's more likely the days of dominance are over for the biggest endowments. Their first mover advantage is gone. Hey, man, there's too much competition for hedge funds and private equity these days. And trust me, they'll all tell you that they're going to be in the top quartile. Yep. You don't know who's going to be in the top, but they'll tell you they're going to be. There will obviously be funds that do better than others. I wouldn't count out people like David Swensen just yet, but with all those CIOs and funds trying to copy Swensen should realize the high cost, illiquid fund structures, complex portfolios, and hard to understand investments create a ridiculously high hurdle rate. Most of these funds would be better off simplifying their research, their approach, and just going to Vanguard stuff. Man, kudos, my man, Ben. So you should follow this guy, wealthofcommonsense.com. Let's take a look at Ben Carlson's books. Organizational Alpha, sounds boring. Wealth Common Sense, that sounds pretty interesting. But Organizational Alpha, that just makes you sound the Six Sigma. Good night. These engineering, business engineering guys are Six Sigma Alpha. Or black belt. What is it? Alpha black belts. All right, my friends, that's great. I'll put a link in the show notes. I'd love to hear your comments on this, but again, hard to beat Vanguard. We'll see you.